it goes higher again, and then it ends. Or, like we have on the bottom, you can see this, which is typically what happens when you look at a higher time frame trend on a lower time frame, which is completely valid. And one of the things I'm going to cover is how to multi-time frame trade these market structure trends. But if you just look at this, it's complete chaos, even though the core of what matters is this chart is going up. Right? And we'll focus mostly on uptrends. As you know, everything applies equally to a downtrend. Right? It's the same principles. But this, despite making higher highs and higher lows, is very, very difficult. You've parts where there are deeper corrections that come all the way back and almost look like it should not be trending. Then there's a breakout, then there's almost no pullback, but it is a consolidation, then it goes higher. And you look at it on the candlestick chart, and there's wild wicks, and there's full retracements, and there's false breakouts, and everything in between. You best get accustomed to this, because this is how the market's going to look most of the time. So, getting right into it. I'm going in no real particular order here. These are not in order of importance, 2, 3, 4, 5. These are just the order in which I want to cover them. So don't feel like any of this is required to be done in that specific order. But the first thing I want to talk about after that brief introduction to the fact that market structure is messy and that you must just be okay with that. The next thing you want to understand is keep things basic and simple, which is if this is an uptrend, what are the important levels and is price consolidating? So when you see price move, it needs to slow down. If you see a move up or a move down with several big green or big red candles, where it seems like the market's never going to stop pumping or never stop dumping, it will stop. It needs to slow down. And a way you can visualize this is something like moving averages that will catch up. And then you will have consolidation being longer than the trend itself. That's a general rule, and you should measure it. So what that means is, if it breaks out and goes up for 3 candles, it might then go sideways, sideways upwards, sideways downwards, choppy, difficult consolidating price action, deep pullback, shallow pullbacks, for more than that. If it's three candles up, it could take 12 or 15 candles of consolidation before the next move up. So, how you can visualize this is in a couple of strong trends. And what you want to see is price forming important structure levels. So you all know what market structure is. You all know classic ways of determining it. The things you really want to focus on are the swing levels, basically consolidations, which can be short, just a few candles, or they can be longer, several candles, that lead to a clear new high in the trend, if we're going in an uptrend. So how that would look here is you're waiting for price to slow down. If you open up the chart and it's at this point, right? If you open up the chart and it's here, or it's here, or it's here, you should not do anything. Because these are the candles where people make the worst decisions, because they feel like, especially say this second or third, they'll say, oh my God, Pepe's been going up and up and up and up, and now it's here, and like I have to get on board because it's never going to stop, and then you don't get on board, and you're like, I should have got on board, and then you do get in, and then it goes sideways for longer than the trend, right? It goes sideways for 2 moves up, 2 candles up, and then sideways for 12 or 15 candles. And if you're not disciplined about it, it will be very, very confusing, and it will lead you into impulsive trades, and it'll leave you prone to error, to mistakes. So first of all, you want to see, when does price slow down? So an important structure level is one that precedes a major move, such as this, where there's a clear breakout and price stays above the high. That important structure level does not get back retested because price does not slow down. In the next move, it then consolidates. You have another important structure level. For this, I'm just using the candle closes of the lowest red candle. You can use candle wicks if you want. You can use candle bodies or wicks. Up to you. Just be consistent with whichever one you use. Now, this impulse candle holds. So that's one of the signs of positive market structure. You're trying to follow trends generally, unless you're talking about reversals, which we'll come on to later on. But if you're trying to follow a trend, you want to follow the direction of the impulse. Remember, impulse followed by correction followed by impulse. So you have an impulse move here where price moves up, it breaks out from this previous swing, and you have 1, 2, 3, 4 green candles in a row, followed by some sideways. 1, 2, 3, consolidation, does not make new highs, followed by another impulse candle, a large breakout, followed by 1, 2, 3 sideways candles, that's the consolidation, followed by another impulse. Now, you then get 1, 2, 3, 4, 5 candles, followed by a internal break of structure, which looks like this. This is what catches many people out, where you see price going up and you're marking every low, as you should, and then you see that low breaking and you think, oh wait, is this not a BOS or a market structure break? Because from candle close basis, price is going lower. And then it goes again and price goes lower again. You think this must be a downtrend. However, when you zoom out and you remember your important structure level, which is the level that led to the last impulse, you can see clearly that this is just a swing forming. Remember, markets that are in trend will tend to continue that way until there is some kind of major reversal. Another thing you can use is the bands as a visual for this. So on a 4-hour chart for Pepe, we're looking at the bands here, and price, having been extended well above the 1221 bands and having not tested them, slows down and goes sideways and starts to pull back, but does not break the important structure level, and it retests and holds the bands, and the bands do not go red. You have a successful retest with price slowing down and the bands catching up. This structure, this important structure, will produce continuation. So when price starts to slow down, you want to look at the most recent important structure level, which again is your directly preceding the last impulse move, and see how price reacts to that. So instead of breaking this, which would be bearish, price spends quite a bit of time above that level and consolidating. That is bullish because it's an uptrend. Now, where would you actually buy? That would be based upon some kind of reclaim. So say you test the bands and then it comes back above this level here and you see that candle close. So your internal structure with the red dotted lines is important, where price is going up and it seems like it's trending down, but it's above the important level, and then it has an internal break. That's your continuation sign. So you could enter there. So looking at this, you want to make sure that you're focusing on, is price in the same state that it was before, i.e. an uptrend? Yes. Has price broken the most important structure level preceding the impulse? No. Is price slowing down? Yes. Are the bands catching up? Yes. And you don't have to use the bands, but it's just one visual. Therefore, there's no reason to expect Pepe at this point to do anything other than what it has been doing before, which is continue the trend. If you were looking at this just through classical market structure level, you could very, very correctly view it, let's say, from wick to the wick, from the low to the high, and see this as being a deep pullback, like a 75% pullback, which it is. You can see here from the swing low, wick, to the swing high, wick, it does pull back more than 75%. So you might think this should then start to form a range, or it should be the sign of a weakening trend. And that is true, that can be the case. But that's why, if you've done the range trading lessons, that's why, what do I always say? When you have a 75% pullback, it does not mean that it is in a range. It's the very first possible identifier of a weakening trend. But when you look at it through a different lens, and this is always why when you see something that happens, if you just viewed it from, oh, this must slow down now and go into a range, and then you see it break out, you're like, how could that happen? When you take this context, it's in a strong trend. The important structure level did not break. Price consolidated, which it needs to do, because price has to slow down. The market needs to digest the move that has happened. Positions need to build. Chop needs to happen. People need to panic and capitulate and FOMO and chop, chop, chop and get themselves all tied up in knots about, is this bullish, is this bearish? And then you should always expect the primary trend, which is up, to continue until such times as there is a major structure break or some significant sign of weakness, which in this case, if you're looking at something like the bands, would be for the bands to cross red, number one, or important structure levels to break. So price needs to slow down. This is totally normal. This must happen It cannot just keep going up forever. If it does, it's just going to come down equally as fast. And you do see this mostly like on meme coins or like really brand new shit coins or stuff that rugs. You'll see them where they just go like this and there's no pullbacks at all, and then next thing it just comes all the way back down. That's not something that you're going to be trying to trade using principles of market structure. Now, looking again over here at Bonk for a second example, same thing. When you see a impulse breakout like we have here, the impulse candle holds. What does that mean? It means you have an impulse candle, price tries to go lower and it fails to, followed by another impulse, and price stays above that important structure level. So that level, which produced the second impulse, leads price into a consolidation. Now here's something that catches people out very frequently, is mistaking these moves higher, because it is making new highs, is mistaking these moves higher for uptrend continuation. This is a slowing move. Remember, you had an impulse candle followed by an impulse candle followed by not impulse. It just pushes, pushes, pushes. Remember the consolidation. So you have a move up. The consolidation can take many forms. It can go sideways in a compressing pattern. It can pull back in something like a flag. Or it can continue to squeeze ever so slightly higher. None of these are continuations of the trend. The trend ended here. This is consolidation. If it then impulses on, the trend begins again. So what you're looking out for there is the important structure level to hold, price to slow down, and the moving average to catch up if you're using the moving average. And again, same thing. You're looking at the reversal internally, where you have a red candle, the second move down, breaks back above it, also breaks out, continuation happens. Next, internal structure. So here's something that gets misunderstood a lot. You have to understand that there are always trends happening, or at least what you would perceive as a trend, on all different time frames. And in between higher time frame levels, you can also see internal structure. This is what you might know as trending through a range. So if you just look at this and you have a price is set a low, it's set a high, it comes all the way down. This would be what you would call trending through a range. It is making higher highs and higher lows. It is following principles of market structure. However, the last high has not been breached. So everything happening within here could just be forming a lower high. If price goes all the way down, then this never made a new high and it was actually just a bearish retest. So how should you view that? The way you should view that is the closer it gets to this previous level, the more resistance you expect to see. So as it starts to trend up through the range and it makes higher highs, higher lows, you should actually expect it to go towards that level and either hit the liquidity or reverse there. So it's completely normal and should be expected that it will continue to do this. However, keep in mind that even though that looks like a trend forming, we have this on Bitcoin at the moment, even though that looks like a trend forming, be mindful of your higher time frame structure levels. We can see one here. Here we have on Solana at the moment, right now, an internal structure where you have a low and a high, and a higher low, and a higher high, and a higher low. And all of this internal structure formed below the previous swing. So none of this was a breakout. None of this was a confirmed trend, even on that 4-hour time frame. However, it was making higher highs and higher lows internally before it broke out. Now, here's the part that confuses people, because when you zoom out, the exact same thing is happening because of the fractal nature of markets. This is also internal structure. So you've got your high that led to the lowest low. This is the high that matters. You then have a high, low into a high, followed by a higher low, followed by a higher high. So where I have put the green arrows, you can see. This is our internal structure. The low to the high, which is basically, it's this one technically, but it's just this area, to the higher low, to the higher high. So anything that comes back within this area here, as anything above this green arrow, is a valid area for a higher low to form with a target of this. The swing high liquidity, which is the high that led to the lowest low. If you're looking at this low here, the high that led to that lowest low is your internal structure level, the target, your internal structure trend, will be targeting that area. So what was so foolish, just from a market structure perspective, not talking about where the market's going to go next, but what was really foolish was for people to call this a breakout, right? Solana did break out from this internal consolidation. But when you zoom out and you see the primary trend and then your internal structure, what do you have? You have price moving up into the biggest known area of resistance. And even though it's forming higher highs and higher lows, it is not a good idea to buy into a resistance when you are below it. Because at best, the first expectation you should have here is that Solana probably will be able to make it to that liquidity, but that is probably where you would see a proper pullback. That would be your expectation. Because the target of an internal structure is just to hit the swing high or the swing low. It's not to break it. If it breaks it, good, then the market shifts into a different phase, but you will see that by some kind of large impulse through that does not come back. It might retest it, but it doesn't come back. Then you start to look at your structures above. So separate internal structure from the higher time frame view. And this is applicable to really every coin that is below all-time high. Right? Every coin below all-time high will have some form of internal structure. Even if you zoom it out and you go super far out, what is Solana doing here? Solana has a high, the important level, the all-time high from last cycle, all the way to the bear market low. And we formed a high here, and we formed a low here. So if you assume that this is the high, and I'll take off this shit here. If you assume that this is a recent high and this is a recent low, this is an internal structure. We trended up, high or low, but we are still within the broader range, which is denoted by the all-time high. So the target of this internal structure is all-time high. From there, when you get above that, things actually become a bit simpler in that everything above there is new. So you're waiting for the trend to form its tops and form its bottoms new, right? And so you're looking at it to see, is it forming new higher highs and higher lows above previous all-time high resistance? Everything internally is an internal structure, and if you have an internal structure, your target should be the extreme. Whereas, you see a lot of this now where people think that this is the best place to load up and it's going to $500 or $1,000 or whatever. Sure, it can get there. Definitely. And a lot of this is just based on past cycles, right? Where you see Bitcoin, very common, right? You see Bitcoin, you see the old all-time high, and you see this trending up through the previous range. So this was internal market structure from the low into the high, into the higher low, which is hard to see, but it is there. Higher high, higher low, trends up, and then it breaks out. And so people assume that this is just going to keep happening over and over again for everything. But actually, your first target, if you're trading internally, would be to watch the all-time high itself, the major liquidity. And that's exactly what Bitcoin did this cycle. Right? Bitcoin has done that exact move this cycle, where it had an internal trend from the low to the high, to the higher low. These are getting hard to draw. What the fuck, man? There we go. To high, higher low. Fucking hell. To the supposed higher high, but really what that was a completed internal trend. And that's why, if you're looking at this to be a continuation of a higher time frame trend, it's so important for it to make a new high. Then you've invalidated this, which would be this entire thing was just a trend internally within a higher time frame range, targeting liquidity. Then it becomes, actually, no, this is going to price discovery, which again is where you start looking at, okay, we have no resistance above, therefore we look for signs of reversal, that's your new top, signs of reversal, that's your new higher low, and so on and so on. So when you're trending through a range, remember that there are it's fractal in nature, right? So a trend from swing low to swing high forms on a lower time frame as a trend. However, if it's below some kind of resistance, it is not a trend on another time frame, just like Solana, right? Until it breaks all-time high, it is actually not in a large high time frame trend. It is technically still just moving through the range. Once it gets above that, then you can see a clear new trend where, price has never been before. Next, multi-time frame views. So here's how to trade within a multi-time frame view, including a primary time frame, a secondary time frame, and a target. So what's the nature of market structure? It's for trends and reversals, right? That's all that really matters. So you want to identify, first of all, are you in a trend? Which trend are we in? And has there been a reversal? Because you're either going to follow the trend or you're going to play the reversal, targeting the other side. So if you look at this as a multi-time frame, we're looking at the daily and the 4-hour. Look at Bitcoin here, and when you see it on the, on the line chart, this was a downtrend. Price moved down, price moved down, price moved down. Then when candle closed above this swing high, which was the last swing high before the lowest low, you had a daily market structure break. That is an internal MSB, because obviously there is a swing high above. And if you zoom out, there's even more highs above that. So it's an internal structure. Remember what I just said about internal structure? The target of internal structure is not 100k or new all-time highs or whatever. The target of internal structure is the most recent swing high. And specifically the liquidity of that, because price has a tendency to go towards the liquidity. You can mark your swing highs using candle closes, which is completely fine from a structure basis. However, there is a greater tendency for price, especially if it gets as far as there, to go for the actual liquidity itself, because that's where price will have the most participation. And the market exists to facilitate trade, meaning markets want to move to areas where people will do business. We know for certain, always, all the time, there are always orders resting beyond this liquidity. You cannot guarantee that there will be orders there, or how many there will be. You can always guarantee there's orders here. Why? Because there's two types. Number one, stop losses of shorts. And number two, breakout traders. People always want to buy or sell breakouts above or below key highs and lows. So how would you actually trade this? You do this. Wait for the daily market structure break. So you wait for your trend reversal, which on the 4-hour time frame happens here. And then you're looking to find a higher low. So any higher low that forms here should be a good entry because the target has not yet been hit. Now, what it won't look like is the perfect textbook. It looks a little bit messier like this. You have the breakout. You have the MSB. This is where the market shifted from short-term bearish to short-term bullish. And then you're waiting for the pullback. Don't obsess about textbook structure, meaning don't obsess about it looking exactly like this perfectly, because it's probably not going to. Instead, ask yourself, is this a probable higher low? So what would a probable higher low look like? This is where you would use some form of confluence. And one such form of confluence would be something like a gap fill, which is denoted here. So the green box is around an order block, which is the last candle before this impulse breakout. Price then consolidates, and we see the internal break of structures. So if you go to the line chart, it looks like it's trending down here. However, it's trending down into a higher low. Because essentially anything above here, if you're marking out your highs and lows, anything above this wick can form a higher time frame on the daily chart, a higher low. That's why you have your multi-time frame. If you're looking on a daily chart, this is your actual lowest low before this highest high. So as price comes down and you see signs that look like reversal, but it comes into an area where it refills a gap, it holds, it hits that important level, which is the low right before the breakout. It does not break down below it. You don't have to do anything here, right? You don't have to guess at this point. At this point, there is no reason for you to say, I need to buy here because this is going to be the higher low. It's not a guessing game. It's an earliest confirmation game, which looks like invalidation of the internal structure. High, low, lower high, lower low, lower high, lower low, this one, where it breaks back above, here, that is your earliest point to say, this is a lower time frame reversal in the direction of the preceding trend, which on a higher time frame, so we've got a 4-hour bullish reversal in a daily bullish trend, because we've had the bullish market structure break and we know the target, which is above. So price is far more likely, given that it's respecting a daily uptrend, price is far more likely to go to the target above, and you are not near the target yet. That gives you a highly probable entry point. It's all about probabilities. There's no certainty. The probability is that this trend will continue until it hits major liquidity, because it has already done the hardest part, right? It's done the hardest part, which is a daily market structure break. So the 4-hour trend should get respected. And it does. It doesn't look nice, it's choppy, it's messy, but it does form a very valid higher low. The point at which you can call that a higher low is after this MSB, and that will be your time frame or area to start looking for entries. Now with that, you identify your primary time frame daily. You follow your secondary time frame to the target, 4-hour, and you can add confluences for your entry and invalidation. So that's the third part I talked about with the gap, the order block, liquidity sweeps, moving averages, whatever you want. You combine the market structure with another confluence tool. And the emphasis here is on patience. This is why filling gaps tends to work if you apply it correctly. This is why sweeps of liquidity tend to work in terms of they produce the desired result. And this is why moving averages in trends tend to hold. Because it's patience. If you're looking at this gap, a lack of patience is buying anywhere up here. Patience is waiting for it to come back and fill the gap. If you're looking at a moving average, a lack of patience, again, is buying into this breakout. A sign of patience is waiting for it to come back and retest and hold. So it tries to go below the 50, comes back above, and the exact same trigger, that candle close, or even this candle close back above, the exact same trigger shows that it has actually held. Because holding, like if you're talking something like a moving average, holding a moving average does not mean that it has to bounce absolutely perfectly like this. It does not have to do that to be a valid hold. Again, just like market structure, you are not looking for the textbook perfection. You're looking for the area to hold. And this is probably the biggest thing that makes people confused when it comes to market structure, is that in reality, out in the wild, market structure is not nice and clean, and you have to try and zoom out and view it more from a perspective of, is this behaving correctly in the right area? Which is where you pick your primary, pick your secondary, pick your confluence. And don't pick too many. Don't have moving average and order block and liquidity sweep. Pick one. So pick your primary time frame, secondary time frame, and one confluence. Then design a set of rules of what does it mean to hold the moving average? What does it mean to fill the gap? What does the important level look like? And then go and test it. Do not try and add too many things on at once. That's a surefire way to confuse yourself and kill your momentum. So that's the multi-time frame, using 2 time frames in that example. Next, I want to talk a little bit about respecting a trend. So before we get into reversals, if you're looking at a confluence, and all confluence is taking a secondary system, indicator, concept, or whatever, in combination with your primary, which is price, right? Price making higher highs and higher lows, that's an uptrend. Something like the bands holding is a confluence. So if you see the price is respecting the 4-hour bands, meaning the bands stay green and price makes new highs. So the point at which you say it respected the bands is actually not here. People would say, oh, look, it respected the bands. The bands are green, they stayed green, and it got back above. That doesn't mean that the trend is continuing, because of course that can just go into a lower high and go lower. The point at which you can say it respected them is when it makes a new high. When it broke out, that means that this retest of the bands was successful. Even though it went below them, even though it went well below them, they never turned red, and it made a new high. You don't have to do anything within this structure. What you're looking at then is